Welcome to the Aramir Roundtable. Today is the 12th of September, 2018. So welcome. We have our guest Matt from ORATS. But before we get started too far, just a quick disclosure that Aramir Corporation is not a broker-dealer or an investment advisor. This presentation is for educational purposes only. We're not making any specific trade recommendations. We don't know your risk situation and have no way of knowing what level of risk is appropriate for you. The risk of loss in trading options can be substantial, so please be aware of all your risks prior to placing any trades. Past performance is not indicative of future results, and hypothetical computer simulated trades are believed to be accurately represented. However, actual profit or loss may vary due to market factors such as liquidity, slippage, and commissions. Phew. So with that, I'll stop sharing, and while we transfer screen control, you can share your screen, Matt. And it's nice to have you on the roundtable. We did this with Capital Discussions a year or two ago, so it's nice to have you back. And I think if I remember, you're friends with Casey Platt.
Yeah, Casey and I go way back to the days of the SIBO. I went down to the SIBO in the mid-90s, and we were in the same kind of sub-office. They have these arrangements that are sub-clearing firms, and Casey and I used to talk quite a bit. I don't know if you'd like me to get into that or not, but it's an interesting story, I think.
Oh, it's up to you. Yeah, I mean, Casey and I we worked together at Shared Mentoring years ago. So I just had an email from Casey the other day, so we're still in touch.
Okay, great. Yeah, and I have terms and conditions too. When we wrote these terms, I was not a registered advisor. I have since become a registered advisor, but many of the same terms apply. This is for educational purposes, and we'll be talking about backtesting. Options involve risk, and backtesting are simulations. So take this all with a grain of salt, but we work very hard to make this as realistic as possible. Like I started to talk about, I was a trader on the SIBO, a market maker, and was successful down there. Was one of the first ones hardwired, so we can feed in the market data into our systems, and we started to then develop our own proprietary calculations, and that eventually became this research firm called ORATS. And so I eventually on the floor was backing traders, and we came up with methods to monitor historical volatility or realized volatility. We noticed that they were different from what we were experiencing as traders. The profitability was different from what we saw in our research. For example, maybe a close to close said it was a 50 volatility, a high-flying NASDAQ stock that we were trading, but we were owning 50 volatility, implied volatility, and still making money, what we called scalping our gamma, which is hedging our deltas using stock throughout the day. And so we since came up with a method for simulating trading gamma and turning that into a volatility, and that was often different from close-to-close volatility. You can imagine some of the NASDAQ stocks moving a lot intraday, and being missed by just close-to-close computation. So I just wanted to mention that briefly. And then from there, we started doing forecasts of volatility. And from there, we came up with a backtesting front end. And that's what we're going to talk about a little bit today, about backtesting and about our approach to backtesting, and maybe some strategies that we've noticed are interesting. So how does that sound, Tom?
Sounds great.
Okay, excellent. So my firm ORATS has this wheel product. Wheel is basically doing research, doing backtesting, execution, and then reviewing and scanning on those backtests. But we're going to talk about mostly just the backtests here. So at wheel.orats.com, you could go and get a free trial. And Tom and I we have a discounted offering for participants in your group. So we're happy to announce that today. And so without further ado, let's get into a backtest. So basically, the way this works is you come in and you click on new backtest, and IBM is the default symbol that we put in there. We actually provide this as a free trial symbol, so you could kick the tires, and then for paid subscribers, you could then get any symbol unlocked. So I like to test on SPY, since it's one of the most liquid ETFs. And then, you know, what I often talk about is portfolio protection. So, you know, there are various ways to protect your portfolio. Long put for me is the most straightforward way. You could obviously buy volatility products that will go up if the market goes down, but that isn't guaranteed. Whereas a long put is a lot more guaranteed than a volatility product. So, but the problem with long puts are they're very expensive. So let's just let this run on the defaults. Our defaults for a long put, and you can see that our start date for our database goes back to 2007, and we update it weekly. So 9/7 was the last time that we updated the backtest database. It's the 12th as we're coming to you today. Days to expiration, 30, we call it ideal. So we'll try to find expirations as close to 30 as possible, but we have to give it a range because not always is there a 30-day days to expiration out there. So we'll take anything with a minimum of 20 and a maximum of 45 days to expiration. And then we'll look for a delta that is ideally around 30 for this particular test, and minimum 20 and to maximum 50. So that's a pretty wide range, but we just want to make sure that we find options and go ahead and we'll simulate those, you know, starting in 2007 and continuing till, you know, just last Friday. So then I'll press submit, and that's a very basic test. So that's just a long put with the default, and it takes a couple minutes to run. So while that's running, let's do a different long put. And you know, so this long put that I want to talk about is a little bit longer. So maybe 90 days, and then so we'll set that minimum at 60, and that's 30 underneath 90. So 30 above 90 is 120. So we'll go 60 to 120 on the min max days to expiration, and let's go much farther out of the money. Let's go. You know, maybe as far as I don't know, a 5 delta or a 10 delta. Let's do a 10 delta on this. So we'll go 5 minimum and 15 delta maximum, and then we'll see how that looks. So one of the benefits of using a backtester like this is you can run many different tests, and as you can see, we're going to be running quite a few here. So I'm just going to keep firing tests at this, and now I'm going to start testing. You know, what would happen if we were to do some exiting strategies. So let's look at, actually I will pause my screen and pause my Slack. So let's see if we could do some exits. So I clicked on this button that has more parameters. And so some of these parameters are for entry, but let's look at some exit parameters. So how might we exit this particular trade? Well, one of the ways that you would exit it is if your 10 delta reached a specific delta. So let's just say it went way up to, I don't know, this 10 delta went up to a 25 delta. You might exit and then roll it back to a 10 delta. So let's test that exit. Okay, so we'll test that. And another popular exit is called exiting on a profit or a stop loss. So let's try that. So let's go a long put. We'll do that 90-day, 60 to 120. So we're going to keep this all consistent so we could compare these parameters that we're putting in. But let's exit if we get to, you know, you could do this profit, you know, so it's going to be a profit target. And we're not going to be paying very much for this put. So we should get at least twice or 200% of what we paid for the put. So now we're going to run those tests. And as you can see, we're starting to get some results. So the first test, that was just that 30-day test. You could this annual return of 5.56. So let's see what these, if you click on this, you could see what the output is on this test. So this is losing 5.5% a year. That's not a very good investment, and you know, quite costly. And you could see in purple, this is the graph since 2007 of the return. So You made some money obviously in 2008, but you steadily gave it back. You had some blips, and you had a blip in February, but not a very good strategy here. And then the way that we present this is we give some summary statistics, Sharpe ratios, drawdowns, P&L per trade, the win rate 13%. But overall, the strategy was not a very good strategy. And then we could show you how you did each month. You obviously had a very good October of 2008, and where the market went down, I believe about 37%. You made 13%, but the rest of these years were pretty bad. So this strategy, whereas it gives you some protection, is a very expensive strategy. Down here, we show you all the trades. So I'm just going to scroll through all these trades, and it shows you profits here and there. Your latest trade was on the 17th. You bought, a 28 delta, so close to a 30 delta put with 29 days to expiration, very close to 30. The 281s with the stock at 285, and you paid $1.50 for that. Right. So on August 17th, on Friday, it was only worth 38 cents. So you already lost $116 on that one lot. So I'm going to pause for a second and just get any feedback from you. Am I going too fast? Is it any questions so far, or how are we doing so far?
Pretty good. Just had one question. Where did you get the funding? I think he's just talking about when you first were talking about ORATS.
Oh, where did I get the funding to start ORATS?
I think so, yeah.
Oh, okay. Well, I was lucky enough to make a good amount of money on the floor, and I basically funded it myself and then bootstrapped it since then. What bootstrapping means from a funding perspective is you make a little money and then you put it back into ORATS, and so I didn't take a salary for a while, and so that's how we built up ORATS. We kept investing and making more databases and more research, and now we have quite a bit of content out there. So yeah, thanks for that question.
And that's all. I think everybody's keeping up pretty well.
Okay, great. So if we've learned one thing, we don't want to probably do a strategy where we're buying a short-term near-the-money put. It's very expensive. You might do it for a very short time period, but as I'm sure many of you know, that's a difficult way to protect yourself. So let's look at some of the results of the other strategies. I could already see that they're somewhat better, but let's look at this long put where we're just buying the 90-day 10 delta, and so that's about half the loss, half of the cost, and doesn't protect you nearly as much. So only about 6% protection in 2008. And what happened is it looked like you made some, but you gave it back, so you didn't really exit your long put. And so it seems like if we would have exited, if you could see those, that we might have improved the strategy. So let's go back to our back test, and now let's look at when we have two different types of exits, right? We have the exit with a 200%. And that wasn't quite as good as exiting at a specific delta. So let's edit this one. Instead of 200%, let's just try 300% and see how that works. So I'm going to submit that. And then while that's running, we'll look at, so this one so far is the least costly put. So this is again, a 10 delta put, but this one, we're exiting at a 25 delta. So approximately 2.5 times the delta we would exit. And so what happens is we we'll capture some of the moves. So whereas you might see can I do a sketch here?
There's an annotation tool.
Yeah. So yeah, okay. Look at this. I'm drawing. So you could see that you made some money and it blipped up, but you kind of gave it back. So basically what this is saying is in a put, you're basically giving your money away, and then when the market changes direction, you make a lot, but then you might give it back. But if you could figure out where a good exit spot is, you could keep some of that profit, if that makes sense. So that's what we're in backtesting. We could think about. Do I need to clear that? Yeah. Clear. Oh, no. So in back testing, we could start to see some sweet spots and find out, where on, we only had a few chances to where these out of the money puts came into, in May of 2010. Here's August of 2011. August of 15 also, we got a drawdown, and then also in February. But you'll notice in February we didn't get any real benefit from this particular strategy because, if you'll remember, in February the market went down, but it came up. And so if you didn't do anything with your puts, you would not have made any money or captured any of the profit that you would have seen short term. So that's why we're not seeing any profit in that particular month. All right, so let's go back to our back test and let's see if that 300%, that didn't really help too much. So, so far what we're seeing is we have a put that, is losing 1.58%. So, the decision becomes, is that going to be, a viable alternative, for your portfolio? And so what does that mean? So let's just look at what 1.58, that doesn't necessarily mean that that's the most you're going to lose in each month or each year, I should say. But because you did make you did make a couple percent in 2008 and some in other months, but in a very bad year, like 2012 was for this particular strategy, you lost 3.5%. So that's a pretty good drag on your portfolio. So again, and then in the other years, it's around 2%. So you have to make that decision. What are you going to be happy with in these with this type of protection? So I'm going to pivot a little bit now. So we've seen what it costs to protect a portfolio. Let's see, if there are any income strategies that we can look at that might either pay for this type of a strategy or offset it. So one of the things that we'll look at now is just a simple short put. So let's look at SPY and let's look at short puts, and let's look at, I'm not suggesting this method, but if you have a long put or a couple long puts, maybe we could use this to pay for a particular position. So let's just run our defaults. We saw in this long put scenario, at least, that this kind of near the money put was the most expensive. So what we might be hoping is the short put might be a way that we can capitalize on and makes, whereas we're not losing as money, we're making a certain amount of money. So, and while that's running again, we'll try some other tests. So let's go SPY short put, and maybe instead of a 30 delta, let's do a 40 delta. So 0.4, and we'll go 0.3 to 0.5. And let's see if that changes things. And then what we'll also do is let's try some exiting criteria. Like when is a good time to, we saw that we could improve the performance of some of these tests by exiting early. Let's try that with this the short as well. So let's try again exiting in a certain delta, just like we did for the other one. So this is 30. So let's exit if it gets to if it gets to I don't know, 0.8. So if it goes against us, let's try that, and let's try testing if the put goes in our favor. So let's exit with the delta in our favor. So let's say it goes down to, I don't know, a 5 delta. We'll roll up and try to get some more premium, so to speak. And while all those are running, let's try some other tests. Let's do that profit. Let's do that profit test. So let's exit when we've made some money. Let's exit. Now this is a short profit, so we can't go over 100% because that's the most that we can make. But let's try a 50% profit target. Let's see how that looks, and we could even try a stop loss on this put, and let's see if that helps. I don't know if you guys have ideas for what the stop loss should be. Let's just say we lose 100% of our money, and see if that helps. Okay, so we're starting to get some results back. So the short put returns 5.13, and alert people on the call might say, well, how come you only made 5.13 when this is just the mirror image of this 5.56? And what you might figure out is that we do have some slippage built into our trading. So what that means is there's slippage and commissions. So the commissions are $1 a contract, which is typical, maybe conservative. And then we also have slippage. And what that means is you're not going to trade at the midpoint. You're going to trade by traveling, in our case, 75% of the bid-ask spread. So you have to, if you're buying, you have to go travel farther towards the ask. And if you're selling, you have to travel from the ask down to the bid. So you're going to be, it's going to go against you about halfway between the mid-market and the bid or offer, depending on if you're buying or selling. So that's the reason that the short put is 5.13 versus the opposite of 5.56. All right, so now we're starting to see some results here. Actually, I did, let's see. So it looks like the best one right now is this 6.16. So we improved it a percent by, what did we do here? We, oh, this was more in the money. So this was the 40 delta. So let's do something. Let's edit that and let's go for the 50 delta. If the 40 delta is good, let's try the 50 delta, right? So let's see how that looks. And then let's look at some other ones. This one improved it as well. 5.73 was exiting. So that actually helped the strategy when you exited when it had gone in your favor, 5 delta. So let's keep that in the back of our mind. And then here's one that looks like there's something off here. Let me see what happened here. The stop loss, I'll have to check that. I'm not sure exactly why that's showing a negative, but let's look at this one. This was a short put, yeah, with a stop loss of 100%. That didn't really help it a whole lot. So far what we're seeing is the best types of strategies are, oh, and here's even a better one. So this is selling the more at the money strategy, and let's try to improve this as well with an exit when this goes down, or not a stop loss, but when the delta goes down. So let's just, we sold it at a 50 delta. Maybe when it's I don't know, a 10 delta, let's roll into the next one and let's see how that improves our strategy. So now you'll say, well, this is a very risky strategy, a short put strategy, which is true, but let's see how that combines with a long put strategy. So one of the things that we could do is first of all just look at the strategy. Well, so we see that in 2008 the strategy lost 28%. So obviously that's very substantial. And then, how did the long put strategy do that we like? So our best long put strategy is 1.58. So, so this one only made 2%. So we're going to have some significant trouble in, if we were to, perhaps hedge the long put strategy with the short put strategy. So we might say that, hey, this might be a little bit, even if we did, 2 or 3 of this strategy, it still is kind of off. That loss is probably too great for a lot of our comfort. And now you could see we've slightly improved the short put strategy by rolling out of it. So, and let's see how this one did in 2008. I don't expect it to be much different. Yeah, 28%. So 28%. So what is our max loss? So you might, as an investor, you could start to combine. One of the tools that we have is a combination. So if we were to combine this 1.5 strategy, losing 1.5 with making 7, so we might say, well, let's do this in a particular weighting. So we'll only do 20% to the short put and 80%, so maybe 4-to-1 to the long put. And let's see how that combination works. So this is kind of an interesting way to think about trading. Well, that's just barely above a break even, and let's see how this looks as kind of on the kind of the payoff picture. You know, it's really just a flat payoff picture where, again, you lost a fair amount of money in 2008, but nothing hugely substantial, and you actually had some returns in a lot of the other years, of course, except for it looks like had some problems in February of 2018. So again, you might say, well, hey, if I could handle only losing 4%, you know, maybe we'll have a different weighting. So we'll instead of 4-to-1, maybe we'll just do maybe something like the short put at I don't know, maybe 33%, and this at 66%. So 3-to-1, and submit that, and let's see how that does. You know, so that will produce a return, and then the return is, you know, you lost 8% in 2008, but most of the other years look pretty decent. You know, 4%. That was that. You know, 2012, 2013. So, you know, a strategy like this, where, you know, it's kind of like a ratio diagonal, right? So it's 3-to-1, three long puts, 1 short put, and, you know, it's that combination. So these are some of the things that we look at when we're looking at protection, but you know, having a short component to the protection. We'll also do things like a 1x2 combined with a long put. So with that, I'm going to stop there, Tom, and see if we're going in the right direction for people, or if we'd like to look at different types of back tests. But these are the popular ones that we see most of the time.
Yeah, most of our traders are doing spreads, mostly like broken wing butterflies or some variations of iron condors. So people are interested, can you do it for butterflies, verticals, condors, or you know, that kind of stuff. And then somebody also asked, can you do it on 2 option symbols like BXX puts and SPX debit spreads? And I also had a question, do you work with indexes or futures options? So a couple questions there for you.
So no futures options. You know, we do SPX and VIX, and in this way, yes, you can combine 2 separate symbols. Okay. So let's look at so good. It sounds like you have pretty advanced people listening.
We do.
And let's get more complex. So let's get more complex. Let's try that. So here's SPY, and here are the various strategies that we could do. So you see calendars, you're seeing straddles, you're seeing call 1x2, which is a ratio, buy 1, sell 2, and then you're also seeing risk reversals. You're seeing back spreads, which is sell 1, buy 2, iron condor, butterflies, way out of the money puts, verticals, iron butterflies, buy rights, covered calls, productive, you know, covered combo. So quite a few here. So let's do something fun. Let's just do an iron condor, and you know, maybe instead of you know, 30 delta, 10 delta, let's do like a 40 delta, and we'll do 20 to 50. And let's set that thing out. Now, condors take a couple minutes to run, but you know, I think I saw something in the chat. How far back does your data goes to 2007. Verticals, yes, we can. Butterflies, yes. What was the VXX and SPX debit put spreads? So SPX, a debit credits, a debit vertical is a long vertical. I hope we're talking the same language here.
Yeah.
And let's see, where is that? Long OTM put vertical. Let's see, where is the Long call spread.
Can you create your own
Long
custom
put spread.
variations of those?
You can by like we just did in the last one, right? We did a 3x1 diagonal, so that's how you would do that. So here's a 30-day long put credit spread. ATMs. 10 days out. Okay, VXX puts. So short VXX puts. Long VXX or short VXX puts? It seems like it would be short VXX put. Or maybe long VXX puts, yeah. Long outs, okay. So VXX long outs. And I think it was short term, so I think it was 10. We'll do like 5 to, we'll leave it very in it because there aren't, especially way back, there weren't that many. Let's see if there's another comment in here.
You probably don't need to go back to 2007 for that. Maybe,
yeah,
you know, last 5 years or something would be enough.
Right. Okay, so anyway, let's just go back to. Okay, so the Iron Condor came back. So let's have a look at that. So the Iron Condor is 30 days to expiration. It's the 4010. The annual return's 2.64. That looks. So let's see. So it had a bad 2012, and then it's very good 2015. So let's take a look at some of these. So again, all the trades are here. So the last trade on the 24th was the 89.96 call spread with the stock 87, and then 675 put spread. So that's actually doing okay since the 24th. All right, and then you could actually even combine that with, let's just see here. So it had a bad 2012. So here's the VXX long put. It's done pretty well, except for 2015. And here are all the, all the trades in there. So just another thing, obviously, VXX, it gets a little complex when they start splitting it. So what our strategy is we'll get out the day before a split and get in the day after a split. Just it makes our life a lot easier, and it doesn't affect the strategy simulation very much. So there's the VXX put, and actually what we should do is do that that SPX long put spread, but let's only go back to 2013 like I did there, so it'll be a better combination. Let's see, any other people in the chat?
Nothing new.
Okay. So there's that long put spread back to 2007. Long put spreads aren't going to work very well just because of the bleed, but it looks like it might match up pretty well with the long VXX puts.
Are you limited to 4 legs on your back test?
Not, I mean, I guess if you consider you then start combining all these, it's almost unlimited, right? Because
how would you combine, say, a Condor with a put debit spread to help protect it? One of our strategies uses that.
So that would be this right here.
Condor, yeah.
So you'd combine these two.
Oh, interesting.
And so you could go, 100%, 100%. And then, then it will be combined. and then so it'll be slightly positive. But it still had some, that's not that great of a, just we didn't match these up that well. 30-15 versus 40-10. Yeah, it's not a bad matchup, but but that's the technique.
Right.
That's how you do it. So here's this SPX long put spread. This is only back to 2013. So then we could combine that with the VXX. So with the VXX long put, and we'll combine, you could either do 50-50 or go over, but we'll do 50-50, and then that will be a couple percent, or actually 1%. So then that, so that particular strategy, had a bad 2015, but good 16 and 17. So that's not the best matchup. Let's just take a look at the VXX long put. Yeah, so we'd want to find something a little bit, that matches up with these types of years better, or months even better.
And there was a question, what price do you take for closing?
Okay, that's a good question. So we capture, we do a snapshot of the entire Oprah feed along with the stock feeds at 14 minutes before the close. And just as a market maker, that's when we started kind of worrying about deltas in the close, and we changed certain markets. And so, so we take a snapshot 14 minutes before the close, and that's when we do our trading. So, this is a pretty advanced crew. So a couple other things that I think are even more advanced, in the tests, you can use IV rank, or you could plug in your own kind of signal. So you can, in your own signal dates, one of the things that I do for my personal account is I look at, I have a balance between kind of income producing and tail protection, but my income producing, I'll take that. I'll be a lot more nimble with that. So if I see the market trying to look more volatile, I'll get out of my income producing strategies. You might say, well, how do you know when it's going to be more volatile or not? And one of the ways, one of the signals that I use is a contango signal. And what contango is when the front month are below the back month in as far as implied volatilities, and that's how things usually are. But when it starts to go from contango to what's called backwardation, and backwardation is when the front months are above the back months, that's when usually there's a lot of volatility in the market. I'll just look at a graph real quick.
Yeah, a lot of us look at VIX Central for that.
VIX Central, yeah, that's a nice Twitter feed or whatever. But like, I want to. I'll show you a couple things. So, this is the SPY, and this is back in February. So the green is the implied volatility, and the yellow is the historical volatility. So before the market got really ugly, the implied volatility started to rise, quite a bit, and this is one of the signals to look for. Another signal to look for is so we have a big data feed, and actually I already have it up here. So on this data feed, we go back to 2010, and we have things like what the implied volatility is of the front month. And, it's going to be hundreds of data sets, but, the put call slope is one of the things, but we have a contango, what we call slope 45 measurement. And I'm going to go way down to, so right now the contango is positive. So there's positive contango, which means there is contango. And, you know, it started to come down, but now it's kind of gone back up a little bit. This isn't today, this is yesterday. But if we look back, and actually, let me just set this up so we could see it a little bit more clearly. So what I'm going to do is I'm going to look at, you know, how things look in February around the contango, and just to kind of show you what I'm looking at now. So here's again our slope 45 is our contango. So let's go up to January and February. So here's and I'll just highlight. Here's January. So there's January 5th when the you know, the market went down quite a bit, and even happened before then. But you could start to see is the contango, you know, at the beginning of the year was quite high, and then started to come down to where in mid-January it was about flat, and then it went up a little bit, but then it really started to get negative at the end of January and the beginning of February, and then it got very negative. You know, obviously when the market went down very hard. So this is one of the signals that I look for, the short-term contango. Longer-term contango, let's look at what that looked like. So longer-term contango is what, like we have a 1 month and kind of a 2 year measurement. So here's the 1 month and here's the 2 year. So usually we're in a situation where the front month is way below, like almost half of what the 2 year is. So the volatility, even now, let's just see what it is right now. Right now it's about 10 and longer terms 15. So you know, 50% higher, but back then it was almost half, 7 to 15, 8 to 15. But then what happened is it got close, but it actually didn't cross until February 5th. So that's a longer term contango. So it didn't get to backwardation, I should say, until actually February 5th. So that didn't help you too much. It started closing the gap, but it didn't get into backwardation until, like I said, after the market already gave up quite a bit. So I don't know if you want me to go on and talk about this is what we build our backtester on, but we have signals that you can make and then interface with the backtester using the backtest interface. So I'll show you that real quick. It's a little bit more advanced, so I don't want to get too into that, but if you were to,
well, our folks are pretty advanced, so
okay. I'm just saying technical. I shouldn't say advanced, but
yeah.
So if you were to, you know, put a strategy together and then go down to kind of what we call our pro symbol entry and exit, you could you know, paste in your entry and exit points. So if you had your own technical indicators, for example, and you had you know, dates built in, you could paste those dates in and it would only enter and exit on those dates. Does that make sense?
Yeah. Mm-hmm.
So we think we have one of the most powerful backtesters out there. I don't know any that could do the things that we can do, and we're continuing to get more and more advanced. And I'll just show you another thing that we could do. We have this thing called adjusting mid trade. So and this gets a little bit complicated, but so let's just say that you had a strategy, and you know, let's say you were trading a short strangle. So actually, let me start this over. Let's do a new backtest, SPY, short strangle. And what our adjuster does is when a leg is either challenged or you know, when a leg is challenged in this, you can either roll the unchallenged leg up or the challenged leg out. Does that make sense?
Mm-hmm. Yep.
So anyway, so that's what this would say. So we would say if we're challenged, if it goes from a 30 delta to a 50 delta, roll it back out to a 30 delta again.
Is one option to close it?
Well, that the closing one you could do just in our general backtest. So in our general backtest, SPY.
Well, I mean, not the whole position, just that one challenged piece.
Oh, and just only have one leg sitting there.
Right.
Yeah, we actually don't have that as a feature. It's just I understand that strategy, but one of the things that happens, and it makes it a little bit more difficult on our backtest programmer, because now we only have one leg, and that is different from all of our other backtests. So, but that's one of the things that I kind of wanted, actually. Was one of the things that I like to do is this thing called put harvesting, where you have let's just say a short put spread, and then when the when the short leg gets to a certain level, you exit that and only leave on that long put. Right. So you're kind of harvesting. But anyway, Tom, I agree. I think that's one of the things that we want to add, but we don't have that right now. Looks like we have another comment. Yeah, index with weeklies. That's we do. So we have, so SPX. If you we'll just do this real quick. Back, I think the weekly started. Let's keep it easy in 2016. I know they started before then, but we could just say, ideal is 5 days and maybe 3 days to 7 days. So we do have the weeklies in our backtester. Oh, I should mention something else. We do have a parameter that you can not trade the weeklies or only trade the standard expiration. So what this means is you could, if it's unclicked, you use all expirations, standard or non-standard. But if you click it, standard expirations, then we start to ask you, standard expirations are not used, use standard expirations only. So there are a couple ways to utilize standard or non-standard options. Yeah. So like I said, we've been doing this now for backtesting for 10 years, and we do have some of the largest institutions out there, and we're now trying to make this available to advanced traders and getting it out to people that are, like on this call, very advanced and that understand a lot of the intricacies of our backtester. Let me just scroll through to see if there's anything else that I missed. That's interesting. Oh yeah, so you could delta hedge. So what this does is it basically hedges at the end of the day based on the Black-Scholes delta. There's also this thing called entry days where it's staggering. So if you have let's just say a 90-day strategy, you could trade into it every, let's just say 30 days. So you'd have 3 trades on at the same time. This is, I think, very good way to go if you have a longer dated strategy. It kind of gets around the problem of path dependency. Leg 1 versus leg 2, deltas, days to expiration, or strike width. So you could set up your legged strategies a little bit more in a customized manner. Market width ratio, you can tell it not to trade if the bid ask gets too wide. One of the difficulties of backtesting is your data quality. As an ex-market maker, I've learned methods to clean our data, but still there are some times when the market gets really wide. For example, on the 5th of, I actually wrote an article for Wall Street Journal on this, how wide the markets got on February 5th. So you could avoid markets using this parameter, IV rank. So you could only trade when the IV is above a 50 IV rank, for example. Earnings. So we also have, ORATS does a lot of research on earnings. If you've seen our Twitter feed, go there and follow us at @optionrats. We have quite a bit of earnings information on there. And this you can enter a trade a certain amount of days before earnings and exit either after or exit before earnings comes along. So some of our call overriders will want to avoid earnings, for example, or some people just make earning strategies. So this will allow you to test certain earning strategies. And then we talked about adjusting when you're challenged or unchallenged, and that's this. So I think we've pretty much gone over, Tom, all the things that I wanted to go over. We did some basic strategies. We did some tail hedging, and we varied some parameters. We looked how exiting might help a long strategy and how it might help a short strategy. We looked at multi-leg spreads. We looked at combining multi-leg spreads. We looked at combining backtests of different of different symbols. And actually, that reminds me, I could show you if you really want to get if you really want to do some work on your own. We have people that download all this information, so you could download all of the trades in a particular strategy. So, for example, here are all the trades in VXX. And then, you could then do your calculations from there. We also have what our daily returns are. So, so you could download the CSV of your daily returns, what the delta was, what the stock price was at the time, what the option profit was, and how many trades you had on. This is when you're staggering, you might have more than one trade. So we're actually going to get even more detailed in this. So some of our clients like to break out their strategies. So, like I said, there are quite a bit of features to our backtester, and we're continuing to add more. Tom's recommendation to be able to trade out of one leg, I think, is a very good one. And what we do is we'll put that in our well, we have a like programming programming list, and then we just prioritize those, and we get to that list, and you can see this is how we develop a lot of these different parameters, and different output is based on feedback that we get from people like you.
Cool. And then how much is the backtester? I don't think you ever said.
Oh, so for a retail individuals like yourselves, it's $99 a month, but we're giving 20% off, so $79 a month. And for for the institutions and professionals, it goes up from there. So we try to make it approachable, but still gets it's quite a bit of work, and there's it's probably cost us $1 million to build this thing, so we have to recoup, as you could probably imagine.
Oh yeah. And then if they wanted to get that 20% off, is that just send you an email?
Yeah, this comes straight to Matt at ORATS. And here, I'll do it in the annotator.
Yeah, I can put it in the, oh, there we go. I can also put it in the chat too.
Okay. So yeah, just request this. That's an at.
There we go.
This should only take about 10 minutes to write out.
Yeah. And it's short.
Yeah. Whoa. There we go. There's my, so email me, get your discount, and we'll definitely go from there.
So I know a lot of guys do some programming too. Do you guys have data for sale, or is that just the backtester? Or?
No, I mean, that's we have a ton of data in a great API. So if you have questions on that, this is what I use all day long. Is this API? You could get some some very interesting data. So for example, I don't know if we could look at. Let's see, is there a stock coming up with earnings? Let me just look real quick. RHT. So let's look at RHT. And we'll look at implied money. So there's a lot of other information on here. Let me get rid of the annotation. So this is for Red Hat. This is the each expiration's volatility and our confidence in it. So at each delta bucket. And I think what's interesting about Red Hat is it has earnings coming out on the 19th. So that it would be after this expiration on the 14th. So you could look at what our how we treat this earnings effect. So for example, Red Hat is volatility is 31 in the front month, but 64 in the second month. There's a big earnings effect, and we break that earnings effect out. So we would say that the earnings effect for the second month is 26, and so we would say the unadjusted volatility. So so we would say that you should take, after earnings is passed, the volatilities will come down to about this level versus this level right now. So I think that's an interesting thing that we do from a smoothing of volatility. That's one of we call it the smooth market values, and we actually put those values this is kind of historical delayed, so it's over an hour old, but you could see what the implied volatilities are and what our smooth volatility is for each strike. So that's an interesting thing that we have in here, and we also have this historically. So you could say, well, let's see if that comes up. So if you have programmers, you can go back to 2007 and see what all the bid-ask spreads were and all that. So we have historical data, historical summarized data, historical data by expiration. This is what the volatilities were at each delta bucket. Here's the 50 delta on each day. And then what we looked at the beginning, this is my favorite thing to look at, is just a serial view of all of the indicators that we have in our summarized data. So historical volatility, implied volatility at what we call our constant day maturity. And it takes a while because it's going back, it's getting hundreds of data points and going back, but it's back now all the way to 2007. So this is the thing that has that, not the one-day volatility that we talked about at the beginning, close volatilities, constant maturity, 20 days, 30 days, 60 days, 90 days, 6 months, and a bunch of other things. Relationships to ETFs, relationships to the SPY, confidence, implied dividends, implied borrow rates, and there's that contango number as well. So I hope that wasn't too much information, but yeah, we definitely have a massive amount of data that you can get at, and we have a decent API document. So if you're interested in that, again, Matt at ORATS, and that's $99, additional $99 a month for retail as well.
For API, okay, very cool. All right, Matt. Well, I like to keep these to an hour, and we're right at an hour. So I really appreciate you coming on and showing us what ORATS has, and it's really good stuff. So thanks so much for coming on and giving us that 20% off offer.
Yeah, it's my pleasure. Yeah, thank you for the kind comments and the feedback. Good press up.
Yeah. Well, hopefully we'll get you some business, and some of our folks can get some good data and good back testing.
Yeah, great. All right, Tom.
Thanks a lot. Thanks,
you.
everyone. We'll see you.
Boom.